The debate surrounding capital gains tax rates intensifies as the Chancellor approaches the autumn budget. While potential increases aim to address fiscal challenges, history suggests that drastic rate hikes may hinder rather than help economic recovery. The prospect of increasing capital gains tax (CGT) rates has resurfaced as a key policy discussion. The Chancellor, amidst pressing budgetary concerns, might be eyeing CGT as a way to shore up financial deficits. However, there exists a substantial risk that this course of action could have adverse repercussions on both taxpayer behavior and overall economic activity. Historically, CGT rates have faced scrutiny, particularly given their reliance on a small pool of high-value taxpayers. In the financial year leading up to the 5th of April 2023, just 2,000 individuals were responsible for a staggering 37% of all CGT revenues, highlighting a diametric relationship between a few taxpayers and the tax's revenue generation. Many of these individuals realized substantial gains from the sale of unlisted shares, a trend that underscores where the bulk of CGT revenue is derived. The notion of raising the main CGT rate from its current level, recently increased from 20% to 24%, to align more closely with higher income tax thresholds, has been floated within Treasury discussions. However, significant hikes, such as the proposed 39% modeled by officials last year, could inadvertently disincentivize investment and alter individual behavior significantly. For many high earners, the potential for a heavier capital gains tax burden may yield a strategic reevaluation of their investment behaviors, or worse, prompt them to leave the UK entirely and seek tax shelters or alternative jurisdictions. The concentration of CGT liabilities among a small fraction of the population raises alarms about the efficacy of rate increases. Should the Chancellor implement a larger rise in CGT, it is conceivable that many within this taxpayer bracket may respond by altering their investment strategies, such as delaying sales or withdrawing from the market altogether. The unpredictable nature of such adjustments could ultimately lead to a decline in economic activity, resulting in a net loss of tax revenues rather than the intended financial windfall. Policymakers must also consider the possible societal implications of increasing CGT rates. Many of the individuals affected are business owners who may be contemplating transitions involving the sale of their companies. A burgeoning capital gains tax burden could dramatically affect their decisions, potentially stifling entrepreneurial activities and obstructing new business ventures. This could have a cascading effect, limiting job creation and job security across the economy. Although the need for increased tax revenue is a pressing concern, a hurried approach could yield unfavorable outcomes. Increasing CGT rates may indeed fill financial gaps in the short term, but such measures risk alienating a vital sector of the economy that plays an essential role in wealth generation and employment. Balancing the budget should not come at the cost of strangling economic growth. If anything I've written in my blog post resonates with you, and you'd like to discover more of my thoughts about capital gains tax and whether the Chancellor should raise them at the autumn budget, then do feel free to call me on 07434 287 603 and let's see how I can help you.